All right. Hey, once again, we're with our good partner and good friend, Mike Binger at Gradient Investments. Mike, good to see you this morning. How's things in Minnesota?
Minnesota, we're right in in the throes of summer right now. It feels good here to, have weather in the 80s and, it's not raining in a while. So I'm doing pretty good. Happy to be here.
It's been vicious here. We've been in the mid to high 90s and just ridiculous humidity. So, you walk out and you turn into a damp rag, which is terrible. Today is actually pretty moderate. So
Good.
so we welcome the relief. So, and we've had some very interesting news items, things getting kind of really crazy in the election world. The attempt on Donald Trump and everything that goes with that. So I guess that's probably a fair, good
Yeah.
opening. Obviously we're heading into election season, and I have to say, I get such a broad. We don't do politics. That's not our thing, but we get such a broad range of questions from clients. They all think how the election is going to, either rocket everything to the moon or, destroy everything they've ever built. So we kind of see a wide swing pendulum. So give us some insight, kind of update on what's going on in the markets and what your take is on that. So, I know we
Yeah.
tell our clients, I'm anxious to hear what advice you have for them.
Yeah, that's great. I want to separate politics and portfolios slash investments a little bit. So I'm going to talk about the economy and the stock markets in a little bit first. Okay.
Absolutely.
When we look at our economy, the things are pretty darn strong right now, Bruce. I mean, we just got an inflation report that was below 3%, so that is absolutely heading in the right direction, down from 9%, about a year and a half ago.
Whoever thought we'd get excited about 3% inflation?
Yeah, exactly. But
That's
we
crazy.
want healthy inflation in this economy, and that's at about 2.5%. So we are really close to being, kind of in that sweet spot of inflation right now. Um, you, you know, GDP, which is the broadest measure of economic growth in the United States, it gets reported, and that's really in a sweet spot. It's right at about 2.5, 3%. So that's strong growth in the economy. Unemployment continues to remain low. So think about it, Bruce. All of us have been to restaurants and we've been out and we're traveling and we're going to hotels and airports and everything is packed and full. So in my opinion, I think our economy is very strong right now. And it's really a Goldilocks economy where it's not too strong, where we have to worry about inflation, and it's not too weak that we have to worry about recession. We're really gliding along with pretty darn good economic growth. And you know what? The stock market has followed that. I mean, stocks have done very well. Granted, it's been powered by a handful of stocks that are kind of this artificial intelligence theme, but to me, and we're just starting to see that this week, these AI stocks, Nvidia,
Right.
Microsoft, Google, they're starting to plateau a little bit. And now we're starting to see the other 490 stocks in the S&P 500 start to lift a little bit, especially those financials. So,
Right.
to me, that's a good thing and that's opportunity if the market can broaden out a little bit. So the economy is strong. Corporate America, we're right in the middle of earnings right now. Corporate America is pretty strong right now too, and the
Right.
stock market is following those things.
Yeah, I mean, and we're seeing the same thing, and of course, along with that, and we're going to talk about it here in a minute, but we always caution our clients, it's people, I call it selective amnesia. When things are very good, you forget about what can be or what eventually will come, because we know that the markets do ebb and flow, and we have great strong markets, but there will be market adjustments. There will be things that can happen in the portfolio. So we want to also look at opportunities to, for the wealth that we built and we've accumulated in these good markets. How do we protect and preserve those assets during market downturns? So I
Yeah,
mean, do you want to shift to that now and talk about
uh,
it?
certainly. I agree with you, Bruce. I mean, the stock market has been up pretty much in a stair step for the past 18 months.
Yeah.
23 was good.
Yep.
The first half of 24 has been good. And because of that, volatility has gotten very low. And people tend to, just have what I call a recency effect. They've forgotten about volatility. Now,
Right.
over time, Bruce, markets are good, and I still think they're the best game in town.
Agreed.
But Markets are volatile. They are not CDs. They don't go up every day or every quarter or every year. And we've had a nice run. And that's the third leg of the fundamental stool that I like to talk about is stock market valuation. And stocks are a bit on the expensive side right now. And that's just a function that the stock market has been good. So it would not surprise me one bit if we would get a pullback or a correction in the next quarter. And when I say a pullback or correction, I'm talking something in the range of 5 to 10%. And people are going to kind of freak out and think this is, it's the end and it's all happening and we're not going to come back. But pullbacks are normal and they're healthy, but they happen. And I expect one to happen. So, as I think about how do we protect or defend, I mean, number one, most of the people that we work with, our clients, those kind of things, they don't need to hit home runs every year. Yeah, they're building a solid financial plan based off, kind of 7-8% long-term annualized returns.
Right.
So if we can achieve those returns with elements of downside protection, I mean, that's really what we're looking for. And you and I, we're familiar with our structured note and buffered products and portfolios, but I really think this is a great product to own today. So what these are portfolios that offer you the opportunity to go along with the market, to participate in the market's upside to a point. It's a cap.
Right.
So that cap, though, Bruce, is really 11-12% right now. So it's
Right.
It's a
It's
nice
healthy.
annualized cap. Now the trade-off or the benefit of being capped, people go, well, why would I want to be capped? Well, this is why. Because you have the opportunity to earn 11-12% per year. And the trade-off is that now you get some downside protection on the markets. And that could be 15 to 20% downside protection, which is great, helps you sleep better at night. And I think it's especially prudent at this point in time after the markets have ran for 18 months.
Yeah, I mean, I think that's the key is we want to mitigate risk when possible. And I think as you said earlier, I believe the markets are the best game in town. And, I mean, the traditional old staunch position was, you diversify with just stocks versus bonds or stock funds versus bond funds. And, but you're really in a totally unknown situation where, here you have the ability to know in advance what's expected in that market correction area. Basically, will I lose money, or if the market adjusts 10%, do I find that I have protection in place that will not impact that part of my portfolio?
Exactly.
And we're following what Warren Buffett said, which is kind of one of the backbones of our portfolio development, is that you should have a portfolio that has more upside potential than downside potential. And when you have, 50% or 60% of your portfolio in these types of instruments, or in combination with other instruments that have protection, you're accomplishing that. So you have great upside, but mitigating that downside can be very valuable, especially when you're talking about retirement assets.
I couldn't agree more. I mean, look, I referenced this in the, previously, but, folks who are in retirement, I mean, they don't need to get those 30% returns or 20% returns every year. They get 5-6%. If they have the opportunity to make 11-12%, all the better. And, that downside protection is so valuable right now. So if you can lock into a portfolio that for the next 2 years, you can earn 11-12% on an annualized basis and still have 20% downside protection, that's ideal, I think, for this point in the market right now, in where we're at in the market cycle.
And it's something you don't see in the broad spectrum of investment portfolio managers out there, So it's something, it's more of an enhanced planning strategy, and that's what we utilize and why we have that. So we're excited about that, and we like having you guys as a partner because you guys do a really good job of weeding out. There's so many out there in the marketplace, and one thing you guys have been very good is identifying quality, not just quantity, and I think that's very important for our clients. Um, so we've kicked the political football to the end here. What's
All right. All right. Well, let's talk about politics a little bit because we get a lot of questions on it, as I'm sure you're getting a lot of clients calling in, saying like, look, if this person gets elected, I'm going to be so disappointed and I want to go to cash. And the other half of your clients are going, if this person gets elected, I want to go out. So to be honest with you, Bruce, I'm not even sure who's going to be running in November, or which parties. But we had an assassination attempt last week, and that looks there's this. I think it's an interesting website called Predict It that gives you the probabilities of who's going to win the election. And after the Trump assassination attempt, his chances of winning jumped up a little bit. So, over time, I would encourage clients to keep, their portfolio decisions and investment plans separate from their political feelings. There's going to be temptations to call you or to say, oh my God, it looks like this person is going to win. I just got to get out of the market and all those kind of things. I would really encourage your clients, to, before they make any knee-jerk decisions, to call the voice of reason. And Bruce, you're going to be the voice of reason here, and you're going to help them talk about and say, look, we have developed a great financial plan, not for each presidential cycle or each congressional or, Senate cycle. We've developed a plan that works well for 10, 20, 30 years.
Right.
And by the way, this is my opinion. I get some pushback on it, but this is really my opinion. I believe that politicians inherit versus influence. They inherit market cycles and economic cycles that are already in motion.
Okay.
And if those cycles are and if those cycles are positive, the politicians take credit for it. And if they're negative, they blame their predecessor for it. Right. So, if you look back in history, Bruce, over the last 100 years, about half the time we've had Democratic administrations, and the other half the time we've had Republican administrations. That's because, look, we're a pessimistic people, and we give one party 4 to 8 years, and we decide they're not doing a good job. We throw the bums out, and we give the next party 4 to 8 years, and then we decide they're not doing a good job. We throw them out. Right. So in reality, we tend to flip flop on administrations over the past 100 years. But if you overlay a chart of the market just continues to make new highs over the past 100 years. And that's because our economy is resilient, corporate America is resilient, and our consumers and workforce is resilient, and they adapt and they thrive no matter what party is in office.
Yeah, I think that's the key is we especially at WealthKare, we build our strategies such that we expect those market declines. So when somebody says, I want to go to cash, the purpose of going to cash is because I don't want to be subject to some giant market drop. Well, right. There's 30 years ago, that was the answer. You'd go to cash because you really didn't have alternatives. Today, the markets have evolved, the programs have evolved, the planning has evolved, and it's more efficient to where we build portfolios that have built-in inherent stability. So, to know in advance what's going to happen to that part of that portfolio with regard to down market, whether it's wealth preservation where we minimize the downside, or wealth protection where we're eliminating the downside. So, I think the advanced planning is key.
Or Bruce, one of our structured note or buffered portfolios where you actually can make money in a down market.
Right. Yeah, that one. You just made all of our clients and our viewers' heads explode.
Yeah.
And these things are not suitable for everybody. All this is subject to suitability. So that's why we ask you to reach out to us. Let's have the conversation. Let's understand your situation. Let's see if there's a good fit. But as always, we're going to give you the pluses and the minuses, because there are pluses and minuses in all of these opportunities. And we want to be clear about that with you and see if there is a good fit to put you in that best possible position. But Mike, great as always. We look forward to your insight and your relationship with us and friendship. Mike's a pretty good guy. I know Mike, not just professionally, but he's got a great family. I remember because Minneapolis is snow, and I remember being out in Minneapolis and Mike coming in the morning. Well, I shoveled, and I did this, and all the things you had to do to get to the office. So that was pretty funny. But Mike, thanks again. We'll be checking in with you soon again. But until then, enjoy the rest of your summer and be safe and stay cool.
Yep. Thank you so much, Bruce. It's always a pleasure to chat with you.
Take care, Mike. Bye-bye.
Bye.